It is another sea of red out there for stock markets. No respite from last week's bloodletting as this week kicks off, but have the markets finally lost enough? We're getting to some sort of exhaustion point finally, where we have a sort of bargain hunting mindset return to the forefront because, of course, the markets are discounting machines, and eventually they absorb the bad news that there is. They adjust valuations to what that bad news is implying, and then they move on. So, have we finally lost enough to get a little bit of a respite and to get the bargain hunters excited enough to put a toe into the pool? That's the question that we're going to try to figure out here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. We'll start with a look at what the markets did last week, and needless to say, the situation on the equities side of things was anything but encouraging. Another week of steep losses. S&P 500 as a benchmark for risk sentiment writ large off 3.1%, and the NASDAQ here off 3.3%. So clearly the situation looking like the sell-off that we've been watching around growth concerns and risks of recession that have really animated the markets recently, that very clearly here continues. By the way, the title on that chart ought to say the week of March 3rd. So no, that's not old data. That's just a mislabeled chart. So let's move down the list of assets here. And perhaps the one that sticks out the most with a little bit of a misleading view is the bond market. We can see 10-year yields up 2.4% last week. The 2-year yield close to flat, but up just a hair, 0.3%. But lest we get it confused here, the prior week saw losses in excess of 5%. So these gains here don't really represent a meaningful improvement or a meaningful rebound. Losing 5% requires you to gain well in excess of that to get back just to even. And what we saw were very tepid increases, probably motivated by the centrality of the U.S. NFP report and the speech from Chair Powell at the end of last week on Friday. So the bond markets were a little bit better anchored just because they seem to have event risk at the end of the week, and they certainly took their time to react to other things and digest it a little bit. But make no mistake, yields have been significantly reduced against the backdrop of what we're seeing here with these growth concerns. And indeed, as the week started, we see them sliding down yet again. Crude oil down amid all of this. Gold managing to edge out a little bit of a gain as we saw a little bit of consolidation. But again, the prior week saw heavier losses, and you'd need a greater rise than 3.6% just to get back to scratch. So the slight improvement in gold, not exactly anything that represents a meaningful amount of progress. Moreover, it's down again today as the liquidation that we've seen brings selling across the board, people seemingly not really caring about this or that asset just as long as they can sell it and turn it into cash, because the overall mood has become defensive. Last week on the currencies front, that kind of liquidation not benefiting the U.S. dollar, although it is doing a little bit better today. The euro in particular surging nearly 5%, which is an absolutely astronomical move for the most liquid currency cross, the euro US dollar cross. For it to move 5% in a given week, given the vast amounts of liquidity there, is extraordinarily unusual. And so that kind of a surge, certainly echoing elsewhere. The dollar, of course, down against the yen as well. It comes up 1.6% as yields look softer, and frankly, as the dollar looks weaker across the board, the gravitational pull of that euro very strong because it's such a huge component of the dollar market that when it moves, it's going to spill over into other USD denominated crosses. That, of course, follows news that Europe is looking at the US suddenly as an unreliable security umbrella and plans to spend a huge amount of money. Conversations are starting to get into the cumulative trillions of euro to rearm and rebuild military capability. And uniquely, it seems like the UK and France and Germany, if you are a student of history, you might appreciate how unusual this is, all are of a mind together that they are going to go on a large defense build-out spree. That, of course, sending the message that there's going to be a tailwind to growth. There's going to be a whole lot of borrowing and spending. And so interest rates have surged in Europe, and that's not surprisingly helped the euro. So with this backdrop, are we perhaps reaching an exhaustion point? Well, the event risk that's coming up this week certainly begs the question. The first, arguably the most significant, at least at the onset, is the U.S. CPI report. The expectation here that headline inflation is going to tick back down. That's 2.9% expected at the headline, and it's not exactly a huge deviation. The last time we were at 2.9% was just back in December. So this would undo the pop from December into January, where we came up to 3%, and bring us back to the last month of 2024. Same thing for the core number. It popped to 3.3% from December's 3.2%. The implication here is that we're going to retreat back to that level. So not a whole big swing here, but nevertheless a little bit cooler on the inflation front. Now, if you're looking at these dynamic annualized measures of where inflation is trending, at the top here are the 3-month and 6-month changes in CPI annualized. That's how the Fed tends to look at what is happening at a higher frequency trajectory, and that's what we're looking at here to get a sense for what the Fed might make of these numbers. And seems like the answer is not very much. The 3-month CPI trajectory here annualized has been accelerating, suggesting that inflation is going the wrong way. The core, which is, of course, where the Fed tends to be most focused, has started to climb again from December into January. That's the yellow bar right here. The same thing with the 6-month rate for the core. You can see these green bars have started to come up. Likewise, of course, the headline, but it is the core that the Fed cares about most because, needless to say, they don't have much agency over global food and energy prices, which core excludes. Rather, inflation is primarily services. And so it doesn't appear like these numbers are going to change the Fed's calculus in the near term and get them to want to cut rates very much sooner. That, of course, lines up with what we heard from Chair Powell on Friday. He very bluntly said that the U.S. Central Bank does not need to be in a hurry to adjust interest rates, despite the recession concerns now gripping markets. He said the U.S. economy is in a good place despite elevated uncertainty, that the labor market is not a significant source of inflationary pressure, that the 2% inflation goal remains in focus. And while the path will be bumpy, the Fed does not overreact to one or two readings that are higher or lower than anticipated. In other words, the Fed is not going to look at these numbers were they to have some sort of incremental wiggle here or there on inflation that doesn't fundamentally improve the trajectory here, which, as we can see just on the whole, is going the wrong way, and all of a sudden get gung-ho about easing. So then how would markets interpret softer numbers here? Well, if we look at the internals of what was happening in January, we can see there was, in fact, a pickup in inflation, in fact, even in core inflation. But that largely came from the goods component having a significant improvement and the energy component having a little bit of an improvement also. These changes, though, mostly come down to those calculations going from more negative contributions to zero or less negative contributions. So to put this in context, the contribution from goods went from a negative 10 basis points contribution to headline CPI to negative 3. And the contribution from energy went from negative 4 basis points to a positive 6 for a swing of 10. So we're looking at a situation then where the main story isn't so much shifting of the numbers at the top, but what is happening to the growth indication under the surface. As we can clearly see from where inflation mostly lives, it is firmly baked into the core services component of CPI. In fact, of last month's headline 3% inflation rate, 2.62 percentage points, that is to say an overwhelming lion's share, came from core services. And so really the main story here appears to be that you're seeing weakening in the one part of CPI where you do not want to see it if you are in the midst of a growth concern. Because what this is telling you is indeed that growth is cooling. Meanwhile, the central bank is not in a hurry to do anything about it, which of course is not the kind of thing that has positive potential for sentiment. Later in the week, we will have U.S. consumer confidence data that comes out on Friday and tells us a very similar kind of story. Here we've had a dramatic decline in consumer confidence recently, largely as we've seen this eye-watering surge in inflation expectations. We've jumped back to 4.3% for the one-year inflation expectation in this consumer confidence survey, and that's largely reflected, surprise, surprise, uncertainty about tariffs, uncertainty about trade policy, and uncertainty about fiscal policy more broadly. In other words, the very same thing that gave us those scary PMI numbers that began the upswell in recession concerns that have given us the market sell-off that we're looking at now. If you want to date that, just take a look at where the charts are on any given asset on February 21st of this year. That's when those PMIs come out and really spook the markets. That, of course, gave us the weakest numbers for overall sentiment going all the way back to 2023 in November. For the inflation number, it was also the highest expected number since right around then. So the markets are clearly unnerved by what's going on, and the expectation is that they will be unnerved still further. A new 16-month low expected on overall sentiment by economists. Now, taking those two things together, the CPI and the consumer confidence number, doesn't really seem all that encouraging for economic growth. Indeed, if we take a look at what economic growth is made of, This is a chart going all the way back to pre-1950s. We can see that the share of household consumption in GDP has only increased, but in any case has hovered way above everything else and currently sits at around 70%. So if the message from the consumer price index, right, not just inflation, but consumer inflation and consumer sentiment is of weakness, well, then whatever recession fears are at work certainly take front and center stage. And the message from the data we've been looking at, anticipating that the data would start to weaken. This, of course, the City Economic Surprise Index that already started to flash by the second half of November, that U.S. economic data was starting to roll over and warning that recession concerns would come to the forefront. This suggests, now that we're below zero and thereby tending toward disappointment on U.S. economic outcomes, that the path of least resistance for both CPI and for the consumer confidence report is to surprise lower. And if that's the case, the concern becomes a more acute one as it pertains to U.S. growth. And so with the Fed reluctant to cut near term, the upshot starts to be, well, then perhaps we need to price in more easing downwind. Currently, the markets are almost aligned with the Fed as far as about 100 basis points in cuts between now and the end of next year, but all of it is front-loaded to 2025. Well, you might need to put more of it into 2026 without shedding anything from 2025 and building out an overall more dovish view. If the growth picture looks more ominous, thanks to this data flow, and the Fed isn't rushing in to help. That, of course, means lower yields and a weaker dollar, probably doesn't do any wonders for the stock market. Now, outside of the U.S., we will also get a monetary policy announcement from the Bank of Canada, obviously very much within the striking distance of all of this. Very much the expectation, as we can clearly see here, that we are going to get a cut. Here's where the current curve is. That's in the red. A month ago, as we can see, the curve was a little bit less dovish for what was expected. It's become more so, especially toward the end of the year. The purple is a month ago. And then these yellow bars are the difference between the current curve and the current policy rate, just to get a sense for how much easing we're on the menu to see. Now, we can see by April, a quarter of a percentage point in cuts is already there, which is to say that a cut this go around is essentially already baked in, already a given. By the end of the year, 72 basis points have been priced in. In other words, we're looking at 3 cuts from now through year end, including the one that's ostensibly coming this week. That is telling us quite the dovish story already, but of course, with this cut already expected, what the markets are going to want to know is it going to get any more dovish beyond that? Looking past headlines for the trade war and everything else, we can see inflation in Canada has actually anchored recently. Going back to about October of last year, we've sort of gotten stuck around 1.9%, give or take. There was obviously something of a blip here in September, but generally speaking, in the second half of last year and going into this year, inflation seems to have stabilized around the central bank's target. Now, that's despite economic growth looking lower. What we see here is that both the manufacturing and the service sector PMIs for Canada are below this key 50 level. This is what separates growth versus contractions. We can see here readings above 50 speak to growth from the previous month. And of course, now we're below 50, which means that what we have is contraction from the previous month. So both manufacturing and the service sector now under fire. Will the Bank of Canada signal that perhaps they're going to take a still more dovish view? Well, perhaps not, while inflation is sticky here, and perhaps not likewise, considering we're almost certainly on the verge of announcing an election. So to the extent that the central bank can stand aside for now, and to the extent that we have, of course, contracting overall composite PMI telling us that economic activity in Canada is shrinking, but not so much that it's coming outside of the realm of the recent ranges, and might still be consistent with slightly positive GDP over time, at least for the next couple of quarters. The central bank may want not to wade in to this election one way or another. Mark Carney has now taken over for Justin Trudeau at the head of the Liberal Party, and the polls have swung wildly in anticipation of just that. Whereas the Conservatives' Pierre Poilievre was winning this election handily just recently, the polls are now basically deadlocked, and with the advent of Mr. Carney's leadership, they seem to have actually started to very slightly favor the Liberals. So perhaps the Bank of Canada is going to look at this and say, well, we have a closely contested election. We have an inflation rate that is basically on target and isn't going very far, very fast here. The growth situation isn't great, but it hasn't really changed all that dramatically in the past month or two. Perhaps we can still eke out some time here. We're already expected to cut 3 times this year. Perhaps we don't need to change that dramatically so for now. And if that's indeed the case, then we might end up with the ingredients for a Canadian dollar rebound. It has been beaten down in particular around these trade war headlines, but perhaps if the Bank of Canada is only as dovish as is already expected and not more, there is some room for a recovery. And that is macro money for today. As ever, we are here right after overtime, Monday through Thursday. That's a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am also on Mondays and Fridays with Chris for Futures Power Hour, on with Victor Jones for the Price of Truth on Tuesdays, on with Victor and Tom again for First Call as the markets open for the week on Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for joining us. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.